The 30-year yield hit a 14-month high today. This is ahead of the U.S. government's $119 billion bond sale later this week. Here with a look at the role that bonds should play in your portfolio in 2025 is Cooper Howard, Schwab Center for Financial Research, fixed income strategist here. So what is the weighting, what is the percentage that you're recommending for bonds to play in the portfolio mix for investors?
You know, that's a great question, Brad, and one we oftentimes get from clients. And I don't think that there's an exact answer to it. I think really what it depends on is why are you investing in fixed income to begin with? We think that there's really three primary reasons that we recommend fixed income to most of our clients, and that's income, capital preservation, and then diversification is the third reason. So we think that fixed income should play a role in most of our investors' portfolios, but how much is really going to depend on what your goals are, what you're looking for to get from your portfolio. Because at the end of the day, all that a bond is, all that fixed income securities are a contract between you, the investor, and the issuer of that security. So I think sometimes some clients can be confused about what fixed income is, how it should play a role in their portfolio. But for what we suggest, when we tell many of our clients, if they've purchased a CD in the past, that's very similar to purchasing a bond. You know what you're going to get, when you're going to get it, and who that issuer is coming from. So those are kind of the three primary reasons that we suggest investing in fixed income. And I think that it more boils down to who you are as an investor and what your goals are versus what an exact allocation is, just broadly speaking.
The moves in fixed income could also, of course, as always, hinge on what the Fed decides to do. And as of right now, it seems like they're signaling for at least two rate cuts this year is what they've put out into the market's mindset here. What is your best estimation for what could play out and the impact on fixed income?
You know, that is our estimation of what the Fed is going to do as well. So we do estimate that they are going to cut 2 times by 25 basis points each. But in terms of the outlook for 2025, I think that there's a lot of uncertainty, and that could filter into the fixed income markets in terms of a lot of volatility. And if you recently look at just the most recent dot plot, I think that a lot of that uncertainty is displayed in the most recent dot plot. So one Fed official, for example, projected no rate cuts this year, while another Fed official projected 125 basis points of rate cuts this year. So there's a wide dispersion about what Fed officials believe the ending rate for that Fed funds rate is going to be in 2025. But with the economy continuing to perform relatively well, hovering around 3%, unemployment continuing to hover around 4%, and then inflation not meeting the Fed's 2% target, I think the downside for additional rate cuts is going to be limited.
Okay, so all of this in mind, there may be some out there that are trying to figure out where lower rate rate issuers actually might play a role in their own portfolio as well. How are you evaluating this?
You know, when we look at lower rated issuers or kind of some of those more speculative rated issuers, what we generally suggest is start with the bulk of your portfolio into core bond holdings. Those are going to be treasuries, mortgage-backed securities, investment-grade corporate bonds, or potentially municipal bonds, depending on your tax bracket, and then add more aggressive risk or more aggressive income sectors. We suggest to most of our clients no more than 20% of your fixed income portfolios to those aggressive sectors. That's things like high yield corporate bonds, for example. And right now, we think that high yield corporate bonds, they can still play a role in an investment portfolio, but we're just a little cautious on the outlook going forward. And the primary reason is low spreads. So a spread, Brad, is just the additional yield that you receive for investing in that riskier issuer relative to, say, something like a US Treasury. Now, spreads are relatively low, so really what that means is that you're not getting too much additional compensation for taking on that added credit risk. So we, again, still think that high yield corporate bonds or those riskier issuers can play a role in a portfolio, but we're a little bit more cautious because if the economy does deteriorate, those low spreads don't give too much wiggle room in terms of the outlook going forward.
But it seems like what we were starting off the conversation with is that we're not seeing such a major deterioration to the point where it would be classified as a hard landing. So are we seeing from right now in the fixed income landscape that it's more of the traits of a perceived soft landing being carried out or being really enacted here by the Fed?
Yeah, I would agree with that. And one of your previous speakers, they kind of pointed to the outlook for a recession in the next 6 to 12 months is relatively low. I would agree with that. It looks like we are engineering kind of a soft landing where the Fed is coming in. And like I mentioned earlier, with the economy running near 3%, unemployment relatively low, we have seen the trend in inflation start to stall out. Overall, that paints the picture of a relatively healthy economy going forward. And again, that does limit the downside of what the Fed is going to do. But again, our expectation is that they are going to cut interest rates in 2025. And what that should mean is lower short term yields. So the Fed has direct influence over the very short end of the yield curve and a little bit less of an influence over the longer portion of the yield curve. So we do think that the yield curve is going to steepen, meaning short term yields are going to continue to move lower or going to move lower, while longer term yields, it looks like they do have some potential upside from here.